Rising inflation and housing rates. Are we in for another financial crisis? Just some days ago, the Federal Reserve increased its benchmark interest rate by 50 points. This means that they will have the highest interest rate since 2007, just before the Great Economic Recession of 2008. What does this mean? We will talk about the looming financial dangers of these rising interest rates, because the rate hikes are about to get even more ridiculous in the coming months. So far, it seems that the Federal Reserve will not be going away from fighting inflation, and they have changed policies that will end up affecting everything from stock prices to the profits in your savings accounts. Since 2021, the US economy has been mostly dealing with inflation. Ever since then, we have seen an increase in prices for every month. And in June 2022, the inflation went as high as 9.1%. How did the Federal Reserve react? It ordered even more rate hikes to bring down the prices of everything. And it seems to work since inflation is slowly coming down. As of November, the inflation is at 7.1%, but is considerably lower than June's 9.1%. This means that month to month, inflation rose by only 0.1%, and we can get back to more manageable levels of inflation by 2023's end. But what exactly is leading inflation right now? The biggest contributor to inflation is the housing sector. According to latest reports, cost of housing has increased over 0.6% per month, which is actually quite a bit of money, considering that housing on the whole makes up for a third of inflation already. Furthermore, the rent index rose by a staggering 0.8% month over month, and the owner's equivalent rent increased by 0.7% month over month, which means that rent can increase another 5 to 7%. These figures are all based on what is referred to as owner's equivalent rent, which is not a very reliable measure. This data is collected by asking homeowners and is based on opinions rather than facts. For instance, if someone were to ask you what amount of money you would charge for your unfurnished house, then that would be dictated by your opinion of what should be the rent rather than cold hard facts. Rent index also takes into account quality adjustments, which means that newer features should also be figured in while making rent projections. If quality adjustments are taken out of the base rent, then the remainder amount is a lot lower than what you are expected to pay at the end of each month. But the rents themselves are the lagging variable. This means that they only indicate prior data. And recent data indicates that rent amounts have begun to drop. This is good news because the Federal Reserve will not likely use this as a tool to increase tax rates. In fact, every commodity on the list came down, from food prices to car prices to airline fares. There are only a few commodities which have maintained their pricey trends. These include apparel and tobacco. What are the implications of these changes? According to housing giants, most consumers have expressed fears that their mortgage rates will continue to go up. Thankfully, however, housing prices have started to come down. For instance, multi-family houses have decreased in expense. Rents have dropped too, since most people who were renting have moved back with their parents due to increased economic expenses. Occupancy is decreasing and entire subdivisions are being sold to large real estate companies who are renting these units off. Construction of new houses is also slowing down, and rents are finally declining. This is likely to show in the next year lease renewal agreement, when rent will be a lot lower than where they are today. In the stock market, lower than expected inflation has indicated that the worst is behind us. But this may not be true. Since the market thinks in terms of how the future looks instead of how the present is, any anomaly could trigger a massive selling spree. From projections of financial experts, it looks like no one has any idea of what the future will hold for the market, since most of their projected numbers seem to come straight out of the ether. But recent rate hikes to 5.1% could mean that we still have not seen the worst of it. In addition, the projected growth in GDP was decreased from 1.1% to 0.5%, which means that we can see an economic downturn in the next year or so. However, this does not mean that there will be an economic crisis at the same level as that of 2008, since we are unlikely to see abrupt hikes in interest, which will keep inflation on the down low. While this does not mean that the economy is going to boom anytime soon, it certainly does not mean that everybody will lose their money and that 2023 will be more like 2022. The Federal Reserve will attempt to contain inflation as much as possible. This means that the federal funds rate will not go upwards of 5%, which translates to a hike of 25 to 50 basic point rates in February 2023. It will be sometime around in May that we will be able to determine if things take a turn for the positive or the absolute worst for the rest of the year. For the most part, however, the stock market is taking this information positively. Feel free to comment down below if this indeed is the case, or will the market see another drop in rates? Thank you for watching this video, and make sure to like this video and subscribe to the channel. See you in the next video.